Hello and welcome to season 4 of the Mic'd Up Show, where every mortgage has a story. We are the ultimate hub, where the hidden stories behind the mortgage industry come to life. I'm Michael Kelleher. Today, I'm solo. In every episode, we dive deep into the entrepreneurial spirit, the strategic insights, and the breakthrough innovations that built the world's greatest mortgage companies. So, whether you're advancing your career, scouting for industry leaders, or exploring opportunities in fintech or prop tech, you're in the right place. Get ready to unlock the story behind every mortgage. Let's dive in today with Tom Davis, Chief Sales Officer at Deep Haven Mortgage. He's also co chair of the non agency forum that's part of the Mortgage Bankers Association that I've actually been able to partake in and listen. And him, I believe it's Lisa, do a wonderful job together of educating our industry that 1 in 6 deals are going this way, and if you're not part of that, it's going to be a lot harder than it needs to be. So, thank you to Tom, appreciate you taking the time to jump on here today. Anything before we kinda get into your story you wanna share with the audience?
Yeah, no, look, I think in every challenging market, there's opportunity. Either you take share or someone takes it from you. And in today's environment, I think with higher rates, refi cash out game you're seeing that deteriorate. So you have to look at all products and look at ways to just drive level production. It within other products in the market you're not seeing being utilized today. There's niches out there that you could leverage to really grow your business. So
You've all since I've known you, since I've been introduced to you probably 7 years ago, maybe longer, but you've always been ahead of the curve when it comes to product. Well, everybody went technology, you went, we're actually in the mortgage industry, guys, and you've been able to be right. So what drew you into the mortgage? Have you also always been on the niche side, or was it
yeah,
something, a different position and brought you to where you are today?
yeah, pretty much. Really, I've been in mortgage pretty much right out of college, and was in the mortgage space out of the before the great financial crisis. So I was a loan officer, then I became a wholesale account executive. And then we saw these products that, the products that were being manufactured, the private label stuff being manufactured pre-financial crisis, all that stuff basically went away. And that collateral back then is actually different than today's non-agency or non-QM collateral. We can talk about that later on the show. But when the market went away, right, everything went really like FHA, BA, and then your conventional. The agencies really stepped in, and that was the game. Early after the financial crisis, I went to an area and I specialized in a program called the USDA 502 Guaranteed Rural Housing Program, which is a Ginnie Mae product. It was very niche. A lot of folks never heard about it, and that's where I earned my stripes in mortgage for about 7 years. I was an industry expert on the USDA 502 Guaranteed Rural Housing Program in the states that I covered. I had about a 70% market share, and it was only one product. So 7 out of every 10 loans I was buying across the country in my market, and had a commanding, dominating market share. And instead of competing on price, I competed on expertise, knowledge, and focus, and help our clients in these states to leverage the product to create a niche and create opportunity in a very challenging market. Today we're on the opposite side of that, right? The conventional government kind of products, that market share is hyper competitive. And I saw an opportunity over the last, let's call it 7-8 years, as margins compress, originations going from a $4.4 trillion market to as low as 1.8, a year and a half ago. I thought originators, the refi cash out game, which was 75% of the market, that piece, I saw that, going away with rates increasing, and there was a lot of margin compression and consolidation. So I started focusing early adopter in the non-agency space, which is predominantly non-QM, your equity products, and then RTL, which is your fix and flip and bridge. So, those products allow you to differentiate yourself and allow you to tap into new referral partners and allow you to just grow in areas where others aren't really focused on. So, there's a saying out there: the riches are in the niches. So I always try to focus on the niches and help our customers leverage these products to tap into the referral partners, grow their business. And so, I really, in my career, I never really focused on price or competed in price. I always focused on expertise, knowledge, and focus, and focusing on parts of the market where I thought there was upside. And based on the backdrop of the economy and backdrop of the rate environment, a backdrop of the type of borrowers or trends, whether it's investor transactions increasing to an all-time high last year at 30%. So focusing on areas where I'm seeing shifts in the market, being an early adopter and first mover there to create a competitive advantage.
Before we keep going down your personal path,
Yeah.
you have me really, my juice is flowing. It seems on pace with what we're talking about right now. There is so much trapped equity in the industry right now. And I talk to about it all the time with an industry peer, Ralph Armenta, and is
Yeah.
just, and he's been saying it for 4, 5, 6 years now. There seems to be new product coming on the market and also
Yeah.
new technologies. And you have banks that may do it themselves, or I know many banks that don't do it themselves. It
Yeah.
just seems it's a lot of different tentacles or a lot of fragmentation that sounds like it's slowly moving into a more uniform offering. Can you help us make sense of this home equity market,
Yeah.
where it was and it's going, where it is today and where it's going?
Yeah, we could have a whole session on this, but here's the deal. It's a generational opportunity. And what I mean by that is you have 35 trillion in equity in the United States, 35 trillion all-time high. You have 80% of Americans have a rate under 5%. Borrowers that are in these lower note rates, in the 4s and 3s, they're never going to refinance out of that property. It's cheap money. It doesn't make economic sense for them to refi cash out. Right. So people are staying in their homes longer. They're not planning to get rid of that first lien. And originators who are waiting rates to come down to hopefully refinance these folks, that's a big mistake that originators are making today. What I would highly suggest is take a proactive approach and introduce equity products to those borrowers that are not going to refinance cash out through a first lien. And what I mean, and why is that an opportunity? Let me just give you some numbers. So we talked about 35 trillion in tappable equity in the United States. You actually have 5 trillion in consumer debt. It's at an all-time high, whether it's auto, student, or credit card debt. 5 trillion. The average age of a home in the United States, we have an aged housing stock here in the U.S. It's 40 to 50 years old. So people are going to be staying in their homes longer. They don't plan to move, right? Because they can't afford to trade up into a higher note rate. They can't afford the higher taxes, the higher insurance, and they're stuck because of the low note rates. But their average age of a home is 40 to 50 years old. So people want to renovate their homes to current market standards, right? You also have 19 million investment properties in the United States that account for 49.5 million doors. Those investors, those savvy investors, they probably refinance and got a low rate on the first. So what we're seeing them take cash out of their investment properties through an equity product, and then they're leveraging that to go buy more investment properties through a DSCR loan, right? Or they could take the cash out. They're savvy, and depending on what experience they have, they could actually use the equity that they're taking out in their investment property to go build a new home through ground up construction, to renovate uninhabitable properties and bring them back into the market through a fix and flip. So that's one technique. You're seeing investors leverage equity through a DSCR second to do that. And then there are multiple of other reasons why people are leveraging their equity, whether it's life events, paying kids through college. They want to fund their business. We have over 18 million self-employed people in the United States that account for over 30 million businesses. Self-employed want access to capital to grow their business. They want to be opportunistic. And here's another fact. In the United States, you have 24 million millionaires. Of that 24 million millionaires represent 40% of the world millionaire population. And of those 24 millionaires, only 6 of them are actually millionaires that have a net worth over $1 million with liquid assets. 18 million millionaires of the 24 millionaires in the United States, 75% of the millionaires are millionaires because they're equity rich. And so you have this backdrop, equity rich, all-time high equity, consumer debt's on an all-time high. People want to renovate their homes. And originators are waiting for rates to come down to refinance their past clients are making a massive mistake. What they should be doing is picking up the phone and congratulating their past clients. Hey, congratulations on the equity. Congratulations on that low rate I gave you. Have you ever thought about refinancing it? Or have you ever thought about consolidating your debt? Are you looking to renovate your home? What other things do you have going in life? You have all this equity, you could use it as a tool. And another reason, and it's a great conversation, we stay in touch with that borrower. Yeah, and they have a financial need, right? So and I'll tell you this, if the originators are not picking up the phone and not staying in front of their clients, who is? The servicer. And so originators today, brokers or bankers, do a suboptimal, poor job at retaining and recapturing their past clients. In fact, they only have about, when the client does a second loan, whether it's a purchase, refi, an equity product, usually that borrower is going somewhere else more than 70% of the time. So, imagine you having a store and the borrower, comes to your store, gets a loan, but 70% of the time after they visit you, they go to the competitor down the street and they buy from them. And a lot of times when the brokers or bankers are originating loans and they sell the loan to the servicer, right, that's their partner, their investor, but it's also their largest competitor because they're aggressively soliciting their past clients. And if you don't stay in front of if the originator doesn't stay in front of them today, they're making a big mistake because not only are they losing out on the equity loan, but when it's time to do refi cash out, the servicer, if they own the first and second, they have over a 90% recapture rate. And so, not only do you lose the borrower today, but you're losing the borrower in the future. And so that the equity piece is generational. There's a full suite of products out there that you could leverage. At Deep Haven, we have a full suite of equity solutions, whether it's a closed end with alt-doc, whether it's bank statement, P&L, DSCR, and then also we allow for have a digital HELOC, similar to a couple of the other ones that are in the marketplace. What's different than ours is that we allow for bank statements, some alternative docs. We could, if the loan doesn't fit the box, we could underwrite it on a manual basis and look to approve that loan. So having a full suite of equity is extremely important, as important as having a full suite of non-QM.
Wow, I think about the flag football game that just occurred out there in LA. Everybody tuned in, and going into it, we were already talking about NFL players and who's going to play in the flag football Olympics and dreaming of the best combination possible. And if anybody watched the game, the rules are so different in the game and the body type that works. It has totally re-engineered everybody's. It's going to be the narrative for the next 3 years. Do we go with the USA team that was, amateurs, but have not lost a game in flag football worldwide? Or do we try and find the Tyreek Hill, this different body type, and try and get him out there and playing? And we could debate or go into side parts of why that wouldn't work. I guess my point is very hard to teach old dogs new tricks, and then it's even harder to get the people that say it always was this way to start thinking new, especially when it doesn't make sense. The example I said doesn't make sense, how this person could be better than Mahomes or Jalen Hurts or Burrow. The loan officer that exists today, going back to when I originated, we were just we're paid enough, so we always did it first. But the numbers you gave, if you just got a little bit of a lot, you're gonna make a lot more in this industry than a lot of bit of a lot of little.
Yeah.
Everybody's locked in. Can you teach so that the lead like what I'm getting to is to the leaders,
Yeah.
can you teach the pros at firsts into becoming seconds? Or is it better to go out there and get people that are great at call centers and bring them in and have them?
Well, yeah, it's everyone's a little bit. Everyone has a different, let's call it strategy, or has a different model. Offering equity works in every model, right? I know some mega brokers that are doing 300, 400 million a month just in equity. There's all the banks are on HELOCs and closing seconds. All the banks offer HELOCs, right? So here's the deal. Every single borrower that your audience has done a loan with over the last 10 to 15 years, they have equity. They already have the clients. They don't need to go find new clients. I would start in your old client base. And what's nice about that is you could, if you're a senior leader, right, an executive, you run sales at a retail shop, all you need to do is create a marketing campaign to hit all your past clients you've ever done a loan with and say, hey, we have these tools. Do you want to renovate? Do you want to consolidate your debt? And we're seeing it happen right now. Like they're putting for example, on our HELOC, we have a white label product where all you need to do as a loan officer is put your link on your email signature, or you can create flyers, or we have flyers, and you just or email playbook that you could just send to all your clients you've ever done loans with in the last 10 to 15 years. They all have equity. They all have a financial need. They all want to consolidate. They all want to renovate their homes. And you could mass market your last client base and drive leads for your loan officers. I mean, I don't know, there's only a small amount of loan officers or people in our industry that are making more money than they made last year. And the people who are making more money are the people who are focusing on all the products available in the market, not just the equity, but the non-QM side too, right? Because between non-QM equity and fix and flip and bridge and ground up construction, that's about a $400 billion market in 2026. And if we're in a $2 trillion market, that's 1 out of 4, 1 out of every 5 deals. A loan officer can't afford to not embrace and adopt these products, because if they don't, they're losing their borrowers and they're losing their referral partner to other folks in the market, right? And I'm teaching our clients to go to pick up market share and to penetrate relationships by leveraging these products. I mean, think about this, Mike. The top 5% of realtors in the United States, top 5%, they have 90% of the listings in the United States. The bottom 95% of realtors only have 10% of the listings, right? So the people that are moving weight in real estate are the top 5% of realtors. They have 90% of the listings. So we're teaching originators to leverage a full suite of non-QM, full suite of equity, full suite of ground up fix and flip it in ground up fix and flip and bridge loans to tap into the top 5% of realtors who have the transactions. Because if there's 2 LOs that they work with, they probably worked with for the last 10 years, and those are their go-to for all their products. If you have expertise, knowledge, and focus in non-agency on non-QM seconds and RTL, and then you could penetrate that relationship and say, hey, I know you work with Mike and Tom on all your other stuff, but let me tell you why you should do business with me and how I can help you make more money, right? How I can help you close more deals. Once you start getting those deals, you're going to get the other business. And the reason they're going to call you is because their LOs don't have expertise, knowledge, and focus in non-agency. And we're talking about a segment of the market that we're serving 18 million self-employed folks, 19 million investment properties. We're talking about credit events, high income, high net worth. We're talking about foreign nationals, over 40 million people in the United States who are not born here. That's 15% of our population. So these are non-warrantable condos, right? Just like agency borrowers, there's non-agency borrowers in every single town, right? So if you're not doing business in non-agency or non-QM or equity, there's borrowers with equity in every town. And if you're not targeting them and you don't know the products and you don't have a grasp on the products, you're not going to be comfortable selling it. You're not going to be comfortable presenting it to referral partners in your markets. So we spend a lot of time with our customers and partners who we know that, they don't have the expertise. And so we spend a lot of time coming up with a strategic plan doing ongoing training and helping our clients to actually build champions in the organization. And once you have folks in their organization that are doing these loans, and everyone catches on and everyone wants to embrace it because they're like, Mike's income is up 30% year over year, right? And how is he doing it? I need to see what he's doing. I mean, here's another interesting fact. Last year alone, the investor part of the market, if you look at purchase transactions, was 30%, the highest ever on recorded history. So I would challenge everyone that's listening, go to your production for 2025 and look if it's 30%. And if it's not, then you're under indexing the market. If you're at 9 or 10%, right, you got to understand why. It's 1 out of every 3 loans are investor transactions last year. So if that's not your book of business, then if that's not where you're at, then what's the reason for it? Well, I'll tell you the reason. More than likely, the organization or the loan officer is not paying attention to in the investor space. They don't have a full suite of investor solutions. So, and what I mean by a full suite is, having a DSCR product, having a 5 to 9 product, having a DSCR second so investors can cash out to do more deals. In the United States, we have a 5 million undersupply of housing. 5 million, we expect that supply demand imbalance to be around to the year 2040. So loan officers could be a part of the solution and help bring inventory into the market. How do you do that? Construction, renovation, bringing new inventory through construction into the market, and then bringing uninhabitable properties back into the market, right? So now you're actually working with the builder, the developer, the real estate investor. You're providing the financing for the build, right? Then when the loan is done, then you get the takeout loan for the consumer or the investor, that the SCR loan. So on any new construction or renovation, you got 2 deals versus the consumer. It might take 5, they might have a deal every 5 years. And the real estate investor does 5 to 7 transactions a year. So if you get 4 or 5 or 6 of those referrals, now you're adding repeat business, potentially 2 deals for every transaction. The investors, are in their community. They'll tell their other investor buddies. And instead of hunting for purchase transactions 1 at a time, you could, working in the investor space and having a full suite of investor solutions really gives you a competitive advantage. And if you don't have it, you're at a disadvantage and you can't compete.
I'm going a little against what people think my brand is in the industry, but the fact that so many leaders in our industry and my peers and maybe probably myself, the fact that we spend more hours looking at tech demos and not listening to what you just told us, which is cookie crumbs all along the way on different ways. Not only can you make a lot more money, but you can begin to tell a story. You can begin to connect dots on domino deals and start to put it all together. I always say, or this is where I've shifted now, you got to own your zip code. And I think this is a perfect example of why we'll work on taking a lot of these facts and putting in a way you can digest. But if you just focus on everything you said and dominating your zip code with multiple products and be able to handle it, then turn it into equity loans, and equity loans need to buy gutters, and equity loans pay for pools and equity, and you become the money person in town. It's the only way to offset all these enclosed portals that are really going to start taking over, where you can't even compete against all these incentives in these marketplaces you don't have access to on closed listings. So closed listings.
Yeah, the goal is not to compete. For me, it's to dominate. And if you have products and you have the expertise, knowledge, and focus, like, I don't like competing. I like to win and win all the time, right? So I see it in our client base. I mean, we're coming off an all-time record for our company. We're in, March. This is going to be an all-time record for lock volume for us. Month ever in the 12, 30 years that their company's 13 years our company's been around. But we have, 500 correspondents, 4,000 plus brokers. We get a lot of best practices from our clients, and we share those strategies and those practices with our clients. Like the zip code piece, comment that you mentioned. I live in South Florida near the beach. There's a lot of single family ranches from the 1950s, 60s that were built down here. They're tearing those things down and they're doing new construction, and right. And you see it everywhere down here, all the way down into Miami, South Florida. People are renovating tearing down their homes, building new. So getting into with on those projects, everyone down here has equity. You have a lot of foreign national, more than 50% of condo purchases in South Florida are foreign national. You have a lot of non-warrantable condos. In the state of Florida, the top 10 self-employed cities in the United States, Florida has 6 of the top 10 self-employed cities in the United States, right? So what does that tell me? Self-employed, right? A lot of self-employed people, very entrepreneurial spirited state. That's a bank statement alone. So people in South Florida should focus on bank statement. There's a ton of investors down here, foreign national investors, coming in, also just, your traditional investors, et cetera. So, ability to renovate, fix and flip, and everyone down here in South Florida has equity. And so there's, if I just had a conventional or FHA, BA and conventional product, I would be not capturing a sizable part of the market because Florida is a top 3 non-QM state, same as California. So you can't compete in Florida and you can't compete in California as a loan officer if you don't have these products.
So it's not just own your zip code, it's know your zip code and then obviously dominate. We're going to take a quick break with our sponsors because they really help different lenders dominate. Always looking for new sponsors to support the show and always looking for our listeners to reach out to our sponsors, let them know we sent you. We'll be right back after this quick minute. All right, so first half, I think we laid the groundwork. Second half, as we wrap up here in our final 10 minutes, you've been leader of some unbelievable companies as the sales leader, some great positions. You obviously know how to not just sell yourself, but run a sales team. What are some of the signals you think loan officers should be looking at in their community? I know you talked about scenarios, but if you were running a sales team, what would be the first signals you would say look for? And then maybe what are some of the techniques you would say they should start to use when they hear those signals?
Yeah, I mean, from that's a good question. We could talk on that. We could cover a lot there. I would say just understanding the opportunity and putting an action plan together and actually, working that plan is important, right? There's opportunity in every market. It's either you get it or someone else takes it from you, right? And so understanding your market and then coming up with the plan of where you want to tap into. So like I said, if I'm in South Florida, right, very entrepreneurial spirited, I know that how do I get in front of the self-employed people? How do I drive referrals of self-employed borrowers my way, right? In that scenario, right, you would actually go work with CPAs and accountants. How many loan officers are actually working with CPAs and accountants as a referral source? Like I'd go to a CPA conference and I'd put up a booth. I'd go to all the CPAs in my backyard and share, flyers that I specialize in helping self-employed, right? That's an example that a loan officer. There's more self-employed people in the United States than there's veterans, right? If you're an LO and on your site, or your company on your site, if you don't have self-employment solutions, you got to start marketing that, right? Same for investors. Large investor space, start one out of every 30, one out of every 3 deals as investors. How can a loan officer get better at that or tap into that? There's investor clubs in every town. They meet on a Thursday, Wednesday, once a month. Go to that investor club, be a part of that investor club, bring your end-to-end solutions, because then you can tell those investors there that they don't have to sign up with 3 different investors for end-to-end solutions. If you're working with Deephaven, you have non-QM, your standard investor product. You have equity investor or equity solution products, and then you have RTL, fix and flip and bridge. So go to the investor meetings, meet with the investors, present on those products. That's a great way to get. That's where I would start, because obviously between the self-employed and the investor, that's where 80% of the production is coming in the non-QM space. On the equity space, you already have a book of business, right? That you've done business as a LO or a company. I would target those folks. I would work with roofers in your backyard. How many, or the home magazine that, folks for kitchen remodels and roofers. I know a lot of LOs that are crushing it on the equity piece, because someone needs a roof, costs 40, 50,000, right? How they don't have the cash to pay for it. How are they going to do it? They can leverage the equity and get a line of credit to pay off the roof, potentially consolidate their debt, and, maybe consolidate the credit card, do some renovation, and the payment might be lower depending on how much credit card debt they have. So renovation companies is another one. So I would say for the loan officer, rates aren't coming down. Rates are going to stay elevated, and I would tell every loan officer, every company here, if you're waiting on rates to come down for refi cash outs, the cash out game is not first lien refi cash out. The cash out game is equity cash out through second liens and first liens. So what's interesting is, in the United States, you have 40 million people in the United States that own their homes free and clear. All the originators that are, I would say the vast majority that are listening to this, everyone's focusing on purchase and refis, right? 40% of Americans don't have a mortgage. That's a great opportunity for a first lien HELOC to help them with their financial needs, because they have financial needs, whether it's consolidating their consumer debt or it's renovating their home. So that's a target market that I'm sure many folks don't even pay attention to, but it's almost half of Americans own their homes outright, because we're an equity-rich country, right? So how do you tap into that?
Yeah, and it's probably different demographics. The easiest one to relate to is probably the aging in place baby boomer. Children are um, visiting their parents in a cavernous house and trying to figure out what to do with that equity when this housing market's the way it is, right? It's certainly an easy way to tell them there are vehicles without having to sell when you
Yeah.
don't want to.
I think a first lien HELOC is probably better than better than a reverse mortgage or an HEI, where they're giving up equity, right? So all the reverse mortgage kind of originators, that's a first lien HELOC is an alternative to what you're doing today.
When you focus on equity, which is really what home ownership is about, it sounds like it changes the narrative from a negative to a positive sometimes too. And you can really lean into that branding wise, that you're a solutions person that cares about helping customers better utilize their equity. And that's what the equity is there for in many cases.
Yeah. I would say, if you're an originator today and you're not staying in front of your clients, I think the best originators in the country, they stay engaged with their past clients. They always follow up. This is one of the best conversations that you could have. Congratulations on your equity. That rate that you have, you'll never see that again. What are you trying? Do you have any financial goals that you're trying to do right now? What does that look like? And that's an easy conversation. You can have that with every client you've ever done a loan with. And, there's surveys out there that show that a lot of borrowers don't even know that closed-end seconds and HELOCs even exist. A high percentage of the borrowers, they are sitting on all this equity and they don't know how to tap into it. And so I think being an educator, I think the best originators out there are educators, right? They make the borrower feel at ease. They could show them why it makes sense to use this product. If someone's pitching them a refi cash out and they have to pay points, right, and bring, to get a certain rate, they're paying off a $400,000 mortgage at 3, and they're borrowing $100,000, for some rehab and debt consolidation. If you're an originator and you say, hey, this doesn't make financial sense. I know this company is trying to sell you on this product, but if you do an equity here, you're going to win them if your payment is lower, and you could show them why it doesn't make sense to get rid of that 3% mortgage. Because in the future, when it's time to do the refi cash out, they're going to come to you because you give them like advice that makes sense and doesn't put them in a worse position instead of just trying to get a deal. So you want these clients for life. And, I think as an originator, having these products and being able to show, the benefits or the features to the borrower is extremely important. That's why I said you have to be a product knowledge expert when it comes to these products.
Yeah. And a final question, hard to follow up when you're making great point after great point. All I have to do is just recap this after and make sure that people understand what opportunity is here in that opportunity. And you're welcome to say anything in this outro. But my question would be, loan officer loves this, wants to work with Deep Haven. How do they get it up to their capital markets or their lender? Are people doing that today, or do you have to hope that the lender wants to roll it out?
No, they're LOs. We're seeing people embrace from the LO level all the way to the executive level. The reality is that so a lot of non-QM investors in the marketplace only do non-QM. There's very few, if not, I'm not aware of any non-QM investor. I don't consider ourselves a non-QM investor. I consider ourselves a non-agency investor. We have non-QM that's going to hit 150 to 80 billion in 2026. There's equity that's going to be about 120 to 150 billion. There's RTL, which is fix and flip, bridge and ground up construction, another 50 billion. And then you throw the jumbo stuff. So we're a $400 billion market. If you're an originator or you're a mortgage company, you don't have a full suite of non-agency, then you're at a competitive disadvantage. Working with Deep Haven is like getting 3 investors approved, because you would have to go get someone in non-QM. You would have to get someone who has a full suite of equity, including a digital HELOC. There's only a handful of folks in the United States that have a digital HELOC. Deep Haven's the only one on the non-QM side. And we do full doc and alt doc, right? First lien and second lien digital HELOC. And then we have the RTL. But yeah, I would reach out to us at deephavenmortgage.com, or you could reach me directly at tdavis@deephavenmortgage.com. We'll get you set up. We'll put together a discovery call and, and see like what your needs are, what areas you want to tap into, where you are from just adoption point. And I would leave the group or the audience with this. There's the difference between a pro and an amateur is training. The pros, and the money they make. Pros, they train all the time. That's why they make pro money. The amateur makes amateur money because they're not training. And so it's all about training. So if you're not training your LOs and you're not spending time with them and educating them on how about these products, how to source them, where to find these top of borrowers, how to look at different referral partners, and what's happening is those originators aren't originating this stuff, and it doesn't just happen on non-QM or these products. There's a lot of originators or mortgage companies out there that have these products or other products of renovation 2 or 3Ks, some of these other, manufactured homes. But the reason the LOs don't sell it is because they're not comfortable selling it. And they haven't been trained on how to sell it and the features and the advantages. So I would say spend time with your teams, educate them, train them. We have a best in class training support. We do, I would say, over 100 webinars a month for our clients. We do in-person presentation, sales rallies, webinars. We'll even do white label presentations with our clients to their realtor and referral partners. So it takes non-QM and non-agents. It takes a very hands-on approach, and we'd love to help you grow your business.
I was biting my lip the whole time that you are speaking where I try to talk about, which is there is so much opportunity out there if you don't stay entirely addicted to they're just basically selling rates, and you find different opportunities to own your zip code, to go to Deep Haven and find ways to train, better yourself, be a financial planner and a loan officer. Give that message. And I think hopefully some of the listeners today on our journey understand that product is part of going into the heart of mortgage innovation. Remember, every mortgage has a story. We're here to help you write yours. If you enjoyed today's insights from Tom or insights from me, maybe, please subscribe, share it with your network, and connect with us on social media. Until next time, keep pushing the boundaries and uncovering the stories that drive our industry forward.